Hey everybody, we're in the middle of tax season. We're halfway there. I know some of you may still be trying to get your books together, get all your accounting records organized so that way you can send all of your source documents and paperwork to your tax professional to prepare your tax return. Now, some of you, on the other hand, may already have all that information gathered and together. You're just waiting to the last minute to file your return because you know you're going to end up with a tax bill at the end of the year because you made too much revenue. And so you want to get all your money together and make sure that you have enough funds saved up so you can pay your tax bill when it comes due. Now, today in this video, I am going to talk about the top 10 tax deductions for landlords. And yes, before I get into all of the details, I want to give you a little fun fact. Now, research shows that millions of landlords each and every year pay more tax than necessary because they are unaware of the different tax credits and deductions that are available to them. So this could have a big impact on your bottom line. It could be the difference between you making a profit and you having a loss in your business. Now, if you have a loss in your business, that's not a good thing because we're in business to be profitable. So you want to look at what it is that you're spending too much money in so you can, learn how to strategize and make it good profit for your business. Now, if you do have a profit, then you want to make sure you are paying the least amount in taxes by taking all of the credits and deductions that are available to you to claim. Now, if you are new to watching any of my content, my name is Nikki Burns, and I help landlords who specialize in buying single-family and multifamily homes make millions and save on average $25,000 so they can buy more real estate to expand their investment portfolio. So because this video is going to be about the top 10 tax deductions, I'm going to break this video up into a 3-part series. So that way I am not overwhelming you with all of this information because there's a lot of deductions out here. And there's even more than just 10 tax deductions. I just want to talk about the top 10 that are most common to landlords out here. So let's get started. Now, the first deduction that you can take advantage of is the interest deduction. Now, this could be interest from a mortgage interest, or it could be other types of interest, such as credit cards. So let's go in depth with the mortgage interest. Now, the mortgage interest is something that you will typically pay whenever you are purchasing property. So when you're buying a multifamily property or just a single family property and you get a mortgage on that property. So all the interest that you're paying on that mortgage for the term of the loan, whether it's for 15 or 30 years or maybe shorter. So when you're paying all that interest on there, you get to write off the interest that you're paying each and every year. So if your interest is $10,000 for the entire year, hey, that's $10,000 you get to write off on your tax return against your income. Now, in 2018, with the Tax Cuts and Jobs Act that came out, that had limited the interest deduction that you can claim for landlords that are making over $25 million every year in profits on their rentals. Now, you can avoid this limitation by depreciating your property over 30 years instead of the typical 27 and a half years. That way you can, write off more on your tax returns and you get about 2.5 years of additional depreciation to write out. So that is going to help you to eliminate that limitation where you cannot claim that interest if you're making over $25 million a year. Now, the second interest that you could claim would be a credit card interest. Now, I'm not talking about your personal credit cards. I'm talking about your business credit cards. So let's say that you have a credit card that has a $50,000 limit on there and you've already spent half of it on, business expenses. And you still haven't paid off that $25,000 to get your balance back to zero. Well, all the interest that you're paying while you have a balance on your credit card, you can write that off on your tax return. You can write that off on your tax return because that's a business expense that you are incurring, and that is something that you have to continue to pay until you pay off that credit card. Now, moving on to the second tax deduction that you can take advantage of, and that is depreciation. Now, this applies to when you're purchasing a property as well. So when you're purchasing a property, Let's say that you buy a property that's for $100,000. Well, the IRS is not going to allow you to write off that $100,000 in 1 year on your tax return, because that'd be a huge deduction that you would be able to claim on there. So instead of them allowing that to happen and you benefiting by writing it all off up front, the IRS gives you an opportunity to allocate the cost of that purchase, allocate the cost of that property over a certain amount of years. So you're going to reap the benefits and eventually recoup all of your money that you've invested into that property after a certain amount of periods. With residential real estate, the average life of a property that you can write off on your tax returns is 27 and a half years. Now, when I mentioned the interest deduction earlier, you can depreciate your property over 30 years. So the average is actually 27.5 years. So let's just say that you have purchased a property that was $150,000. Okay, get my handy dandy calculator here. And then we divide that $150,000 of the purchase price and we divide it by 27.5 years. So $150,000 divided by 27.5 years. That means you would get to write off $5,455 per year in depreciation. So you get to write off that same amount every year until you reach that 27 and a half years. Now, depending on which depreciation method that you choose, which I'm not going to go into details about that because there are so many methods, that will determine how much depreciation you can write off. Now, the way I calculated this depreciation was using the straight line method. So that evens it out. That evens out your depreciation for the entire years that you're going to be using the property. Now, if you sell the property sooner, it'll be different. Now, moving on to the third strategy, and that is repairs. Now, this includes any repairs that you incur while your tenants are using your property. So it could be any repairs that are necessary, ordinary, and have a reasonable amount. So any repairs that you use to improve the property cannot be written off on your tax return right away. It has to be allocated to the basis of the property. So the only repairs that you would be able to write off would be things like, let's say, fixing a window, something that's necessary, or replacing a hot water heater for a tenant. That's necessary because you cannot go without hot water in your property. Anyone that does, hey, I don't know what to tell you. That's another story. So these expenses must be ordinary necessary. Now, these are the top 3 deductions for this video. And if you want to learn more about the different deductions and tax loopholes that are available for landlords to take advantage of, then feel free to click that link down there below to schedule a tax planning session with me where I can help you and assist you go over the different tax loopholes that you can take advantage of and make sure that you're always paying the least amount in taxes each and every year. Now, until then, I will see you guys on the second video for part number 2.